Preparing for a sales and trading at JPMorgan Chase Co interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in sales and trading at JPMorgan Chase? I would frame JPMorgan as a markets franchise with scale across rates, credit, equities, FX, commodities, and prime services. That matters because sales and trading is a flow business. Better distribution, balance sheet, research, and technology create better liquidity for clients. I would also connect my interest to the desk, show I follow markets daily, and explain why I like fast decisions, client interaction, and disciplined risk-taking. While answering, focus on JPMorgan's global markets franchise, client reach, balance sheet strength, technology, and your personal fit with fast-paced markets, risk-taking, teamwork, and client-driven problem-solving. Question 2. What does a market maker do, and how does the desk make money? A market maker provides liquidity by quoting a bid where they buy and an offer where they sell. If I quote a bond at 99.90 bid and 100.00 offer, the spread compensates the desk for inventory risk, funding, hedging costs, and market volatility. The goal is not just to speculate, it is to facilitate client flow, manage the position quickly, and use pricing discipline to earn spread over many trades. Make sure to cover bid-offer spread, client liquidity provision, inventory risk, hedging, turnover, franchise value, and the difference between earning spread versus taking outright directional risk. Question 3. Pitch me a current market trade idea you would discuss with a JPMorgan trading desk. I would pitch being long U.S. duration through 10-year Treasury futures if inflation data continues to soften and the Fed signals a more balanced reaction function. The catalyst would be weaker payrolls or core CPI, with the target being lower yields as markets price future cuts. I would size it conservatively because supply and term premium can push yields higher. My stop would be a hawkish Fed repricing or a strong inflation surprise. In your answer, talk about catalyst, asset class, trade structure, entry level, target, stop loss, risk reward, key data releases, and what would prove your thesis wrong. Question 4. How would you explain the relationship between interest rates and bond prices? Bond prices and yields move inversely because the bond's fixed cash flows are discounted at the market yield. If yields rise, those cash flows are worth less today, so the price falls. Duration measures that sensitivity. A higher duration bond loses more for the same yield move. Convexity refines the estimate for larger moves. Traders care because even a few basis points can create meaningful profit and loss on large notional positions. Be sure to mention inverse price-yield relationship, discounted cash flows, duration, convexity, longer maturity sensitivity, coupon impact, and why traders care about basis point moves. Question 5. What is duration, and how would a rates trader use it? Duration tells me how sensitive a bond or portfolio is to changes in interest rates. In practice, a rates trader often thinks in DV01, how many dollars are gained or lost for a 1 basis point move. If a book has positive DV01, it benefits when yields fall. The trader can hedge that exposure with futures, swaps, or offsetting bonds. Duration is powerful, but for large yield moves, convexity also matters. While answering, focus on duration, price sensitivity to yield changes, DV01, hedging, curve positioning, portfolio risk, and why modified duration is only an approximation. Question 6. What is the difference between sales and trading roles on a markets desk? Sales owns the client relationship, understanding investor objectives, axes, constraints, and trade ideas. Trading owns pricing, execution, risk, inventory, and hedging. The best desks work as one unit. Sales brings market color and client demand. Traders provide executable levels and risk appetite. At JPMorgan, the scale of client flow makes that communication especially valuable because a trader's pricing decision often depends on both market conditions and expected franchise flow. Make sure to distinguish client relationship management from risk warehousing, pricing, execution, and hedging, while emphasizing collaboration, information flow, suitability, and delivering solutions to institutional clients. Question 7. Walk me through what happens when an institutional client wants to buy a large block of stock. First, the salesperson clarifies the client's objective, urgency, size, and constraints. The trader then assesses liquidity, recent volume, volatility, and market impact. If executed agency, the desk works the order using algorithms or high-touch execution. If principal, the desk may commit capital and quote a price for the block. The key risks are adverse selection, information leakage, and residual inventory. After execution, the desk monitors hedging, profit and loss, and client feedback. In your answer, discuss liquidity assessment, market impact, agency versus principal execution, block pricing, hedging, information leakage, algos, compliance, and post-trade risk management. Question 8. How do FX spot and forward trades differ? FX spot is an exchange of currencies for near-term settlement, usually T+2. A forward locks in an exchange rate for a future date. The forward rate is driven mainly by the spot rate and the interest rate differential between the two currencies, not just a market prediction. For example, a corporate with future euro revenues may sell EUR/USD forward to hedge. The desk prices the forward using forward points, funding, liquidity, and credit considerations. Be sure to cover immediate versus future settlement, interest rate differentials, forward points, carry, hedging import or export exposures, and why forwards are not simple forecasts. Question 9. What is bid-ask spread, and why does it widen during volatile markets? The bid-ask spread is the difference between where a dealer is willing to buy and sell. It compensates the market maker for taking risk and providing immediacy. During volatile periods, prices move faster, liquidity is thinner, and the probability of trading against better-informed counterparties rises. That makes inventory harder to hedge and more expensive to hold. So spreads widen to reflect uncertainty, protect the desk, and ration scarce liquidity. While answering, focus on compensation for liquidity provision, inventory risk, uncertainty, volatility, lower depth, funding costs, adverse selection, and how client urgency affects execution pricing. Question 10. If the Federal Reserve unexpectedly hikes rates, what happens across major asset classes? An unexpected Fed hike usually pushes front-end yields higher first, because policy expectations reset. Bond prices fall, and the curve may flatten if investors expect tighter policy to slow growth. Equities often sell off, especially long-duration growth stocks, because discount rates rise. The dollar may strengthen as rate differentials move in its favor. Credit spreads can widen if recession risk increases. The exact reaction depends on what was priced in and the Fed's forward guidance. In your answer, cover bonds, yield curve, equities, growth versus value, USD, commodities, credit spreads, and explain that market reaction depends on expectations and guidance. Question 11. Explain delta, gamma, vega, and theta to a non-technical client. Delta is the option's sensitivity to the underlying price. It tells me how stock-like the option behaves. Gamma measures how quickly that delta changes, which matters when markets move sharply. Vega is sensitivity to implied volatility, so it rises when the market expects bigger future moves. Theta is time decay. The option loses value as expiration approaches, all else equal. Traders monitor these Greeks because an options book's risk changes continuously. Make sure to define each Greek intuitively, link them to option price drivers, use plain language, and mention how traders hedge and monitor changing exposures. Question 12. What is implied volatility, and how is it different from realized volatility? Realized volatility is what the asset actually did over a past period, measured from historical price moves. Implied volatility is the volatility level embedded in option prices today. If options are expensive, implied volatility is high relative to realized volatility. Traders compare the two to judge whether options look rich or cheap, but they also consider catalysts like earnings, central bank meetings, or geopolitical events. Implied volatility is forward-looking and driven by supply and demand. Be sure to mention implied volatility as market-priced expectation from options, realized volatility as historical movement, volatility risk premium, event risk, and how traders compare the two. Question 13. How would you manage a trading position that is moving against you? I would first separate profit and loss pain from thesis validity. If the reason for the trade is broken, I cut or reduce the position. If the thesis still holds but timing is wrong, I reassess sizing, liquidity, and hedges. I would check stop-loss levels, risk limits, and upcoming catalysts, then communicate clearly with the desk. The worst response is emotional averaging down. In trading, preserving capital and credibility matters more than being right. While answering, focus on predefined risk limits, thesis review, liquidity, hedging, stop-loss discipline, communication with senior traders, avoiding emotional averaging down, and protecting capital. Question 14. What is value at risk, and what are its limitations? Value at risk estimates the maximum expected loss over a defined horizon at a given confidence level. For example, one-day 99% VAR of $10 million means the model expects losses above $10 million on roughly 1 out of 100 days. Its weakness is that it does not explain how bad that one day can be. VAR also relies on assumptions and historical data, so desks pair it with stress testing and scenario analysis. Make sure to cover VAR as a statistical loss estimate, confidence interval, time horizon, historical or model-based inputs, tail risk, liquidity gaps, and stress testing. Question 15. How would you think about credit spreads widening in the corporate bond market? Credit spreads widen when investors demand more compensation over risk-free rates to hold corporate credit. That can reflect higher default risk, downgrade concerns, weaker liquidity, or broader risk-off sentiment. A cyclical issuer's spread may widen more than a defensive utility because earnings are more exposed to downturns. For a credit trader, the key is identifying whether widening is justified by fundamentals or driven by technical selling and liquidity pressure. In your answer, discuss default risk, downgrade risk, liquidity premium, macro uncertainty, risk appetite, sector differences, treasury yield interaction, and implications for credit trading. Question 16. A client asks whether to issue fixed rate or floating rate debt. How would you frame the discussion? I would start with the client's business model, cash flow predictability, and tolerance for rate volatility. Fixed rate debt gives certainty and protects against rising rates, but may be more expensive if rates fall. Floating rate debt can be cheaper initially, but exposes the company to higher interest expense. The client can also issue one format and use swaps to transform exposure. The right answer is not a rate call alone. It must fit the liability profile. Be sure to cover rate outlook, liability profile, cash flow stability, duration, swaps, funding cost, risk tolerance, accounting constraints, and matching debt structure to business needs. Question 17. What is a yield curve and what does an inverted yield curve signal? A yield curve shows interest rates across maturities for the same issuer, usually treasuries. A normal curve slopes upward because investors demand more yield for longer maturity risk. An inverted curve means short-term rates exceed long-term rates, often because markets expect tight central bank policy to slow growth and eventually lead to rate cuts. It is watched as a recession signal, but it is not perfect. Term premium, supply, and global demand also influence the curve. While answering, focus on maturities, term premium, monetary policy expectations, normal versus inverted curves, recession signals, front-end sensitivity, and limits of interpreting curves mechanically. Question 18. How do you stay informed about markets? And what indicators would you track every morning? I would build a consistent morning process. First, I check overnight equity futures, treasury yields, the dollar, oil, gold, credit spreads, and volatility indices. Then I look at major news, central bank headlines, economic releases, and earnings or geopolitical developments. I would also read desk color and JPMorgan research to understand positioning and client themes. The goal is not to memorize headlines. It is to know what moved, why, and what matters next. Make sure to mention a repeatable routine major equity indices, rates, FX, commodities, credit spreads, volatility, economic calendar, central bank speakers, earnings, and JPMorgan research usage. Question 19. Give me an example of a time you made a decision with incomplete information. I would choose an example where I had limited data but needed a timely decision. I would explain the situation, the options, the key risks, and how I prioritized the most reliable information. Then I would show the action I took, how I communicated uncertainty, and what happened. The trading link is judgment under pressure. You rarely have perfect information, so you need a process, risk limits, and the humility to adjust quickly. In your answer, use a clear star structure. Emphasize analytical judgment, speed, risk controls, communication, adaptability, and what you learned that applies to trading environments. Question 20. If you were given $10 million to invest for 6 months, how would you allocate it today? With only 6 months, I would prioritize capital preservation and liquidity over aggressive return. I might allocate a large portion to short-duration treasuries or high-quality money market instruments, because yields are meaningful and duration risk is limited. I would keep a smaller allocation for liquid risk assets if my macro view supports it, such as broad equity exposure or investment-grade credit. I would avoid illiquid trades and define downside limits upfront. Be sure to discuss investment objective, risk tolerance, time horizon, liquidity, macro view, diversification, downside protection, expected return, and clear reasoning rather than overconfident market calls. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.